Hey, welcome back. It's just the kickoff of hour 2 of Liquid Lunch on Newsmax TV. I'm John Tobacco. We'll come to you today as we do every day live from noon to 2 Eastern from the Newsmax headquarters in Midtown Manhattan. And on Money Monday, we bring you everything that's going on in the markets and your portfolio and all that good stuff. We bring you the money guests. And we have just another one for you today. But just before we get to Stan Bharti, checking the Dow Jones at the New York Stock Exchange downtown, still up about 260 points, reapproaching that 26,000 level. At 26,000, I believe there was some good support. I'd like to see the market get up above 26 and close there for the end of the summer. Next week, people will come back. It'll be a new month. People, these programs, a lot of traders have their on autopilot right now, so they can go hang out in the Hamptons for the week, and they'll rebalance when they get back next Tuesday. So the Dow seems to be recovering nicely with some of these tariff fears subsided just a little bit. Joining us now is Stan Bharti. Stan is the CEO of Forbes and Manhattan, and you are an expert in all things commodities. Today, I was hoping we could talk about gold and oil and how they're affected by the value of the U.S. dollar, by what's happening with the trade wars. I seem to feel like the more the U.S. markets come under attack, or at least have these big volatile days, there's a flight to safety in gold. And what should our audience at home know about gold these days?
Well, first of all, I think we've had one of the best bull markets in equities in the last 10, 12 years. I haven't seen a market like this in a long time, and I've been in the business for 35 years. And after such a run in equities, what typically happens is you get a rush to hard assets. And the first hard asset that people look to is gold. So we've seen gold is at 1540 today. Last time we saw gold as high was 1900, 1980 in 2012. We believe that gold is on an uptick, and over the next 2 years, it could surpass $2,000 an ounce.
So you think there's a flight to safety trade there when the U.S. markets get a little hairy, people go to something physical like gold?
I think it's a bigger picture than that. It's a picture where for the last 10, 12 years, the S&P 500, the Dow have been giving 8, 10, 12% returns, which are phenomenal returns. When you look at the Fed rate, is 2.5%. 3%, 1.5%. So you get a huge spread. And I think that spread is implied indirect inflation, or some way that spread has to be covered. And people, smart money is not realizing, listen, for 10 years, we made a 3x, 5x on money in equities. And now we should look at hard assets. And that is not just gold, oil, real estate. Some of the other commodities will all do very well. I think we're going to be one of the biggest booms in hard assets we've seen in the last 20 years.
So we share many of the same economic thoughts about gold and interest. We also share a tailor, because if you would take a close look, both Stan and I have very similar shirts on today. We got the blue plaid memo, but there's also this crazy correlation between the strength of the U.S. dollar and how commodities trade, because most commodities are traded around the world in the spot market off the U.S. dollar. So when the U.S. dollar gets stronger, other countries have to pay more for oil to buy it in U.S. dollars. Is the oil trend going to continue? Or
first of all, the oil trend, I think oil, the last bull cycle in oil we saw was in 2008. Oil hit $140 a barrel. As we know, gold hit almost $1,900. All the other commodities, copper, zinc, lead, all went high. And absolutely, partly strike to the U.S. dollar. Many times we've seen the U.S. dollar stay strong, but the equities get hurt. So we believe that, at 2,700, 2,600,000 Dow, S&P at almost 3,000, these have been phenomenal runs, unheard of runs. And to give you a crazy example, I had a friend who used to be in the markets in the 60s, and his analyst at that time predicted, he said, Dow's going to hit 1,000. And they fired him. They said, Dow at 1,000. And here we are at 27,000 for the Dow. So we've had great runs, valid runs, but I think the shift is coming in the next 12 to 24 months. And it'll be a big shift. The U.S. dollar may stay strong because the U.S. is still the economy that drives the world. There's no question about it.
Stan, let me ask you a practical question. If people are watching this and they're saying, you know what? I'm picking up what he's putting down. I do think that this bull run on commodities is going to continue. On a practical level, what's the best way for the rank and file trader, not a John Tobacco or a professional Wall Street tycoon? What's the best way to add gold to your portfolio? Is it through an ETF? Is it through some fund that trades in gold? If I'm just a Joe Q public investor, how do I add a little bit of gold?
So there's several ways of adding. Obviously, the safest way is to buy the hard asset, okay, or ETFs. ETFs, represent the price of gold. But the leverage in gold is through equities. That's always been, and then within equities, we have three categories. We've got the seniors, the intermediates, the juniors. Typically senior, and these are defined by the amount of production you have, where you're located, everything else like that. But the juniors, for example, in the last bull market in gold that started in 2003 and lasted until 2014, went up 10 to 20 times. So for more speculative, younger investors, I would recommend junior equities. For mature investors, there's major, intermediate, major stocks, and I can give you some examples, but obviously...
Give us some examples of the juniors.
So
we talk to our audience a lot about educating themselves, making sure this stuff is suitable, so we don't give out financial advice. But you being an expert in these fields, for people who want to put a little bit of a growth stock in a hard commodity like gold, what are some names that people should look at for themselves and get to know about?
So in the juniors, for example, two groups that I'm involved with, one is called African Gold. It's listed on the Toronto Venture Exchange. Toronto, by the way, is the focal point for a lot of mining stocks and has been for many years. At one time, 70% of all mining stocks financings were done in Toronto. So it's a huge center for mining stocks. So when I mention Toronto and you're looking for gold, it's a logical exchange to deal with. We've got African Gold. Let me give you an example of this project. Stock came off from 2014 to 2018, about 80-90% because everyone ran away from gold. It's a fully permitted project in West Africa in a country called Mali, which is already permitted. The country is the third largest gold producer. Stocks trading at about 40 cents or so, 45 cents. These stocks have the leverage to go up several times in a bull gold market. Another example I'll give you of a project again I'm involved with called Eurosun, the second largest gold deposit in Europe, located in Romania, which is in the European Union. This again had a market cap of a few $100 million. It's come off a lot. Great opportunity to buy. They just got their exploitation permit in Romania.
Stan, let me ask you a little bit about oil prices. We see a lot of what's happening with Iran. People are panicking every time a ship goes through the Strait of Hormuz. Iran saying that the oil on the tanker that was seized has now been sold. We see also the problems in Brazil, not only the ecological problems with the Amazon fires, but the political turmoil that is with this back and forth with Bolsonaro and the opposition there. Where are we heading in terms of oil prices specifically? And are folks going to see a difference, not necessarily in their portfolio, but in the price they're paying at the pump?
So, first of all, I think oil in the next 3 to 4 years is a buy as a commodity. Having said that, remember 55% or 60% of what the crude comes out is not for fuel and for gasoline and for cars. It's really for plastics, it's glycerin, it's all the chemicals we use. And the big shift we're seeing in oil is that more companies are now making petrochemical plants rather than oil plants because petrochemicals come at a good price. Listen, the reality is plastics have a lot of downside, but today the world cannot live without plastics. Packaging, health, environment, plastics are very important. So oil is always going to stay with us, but the shift will go to petrochemicals. Then secondly, in the short term, the world economy is going from 7 billion to 10 billion people, and these are official records. So with that economy, fuel will continue to be a huge machine. Emerging markets, very big. Africa, half of Africa doesn't have power. Diesel power is the only way. Parts of Brazil and the Amazon, we talked about it, they don't have power. Diesel power is the only way. And shifting to the Amazon, first of all, I want to congratulate the G7 and the government of Brazil for coming to terms and for the G7 helping stop the fires in Amazon. As we know, the fires in Amazon, it's partly because it's a dry season, but partly there are some reasons why these fires are caused. And I think the government is finally taking the right steps by sending the army. But it's a big issue that the world needs to deal with in the Amazon. It's a very serious issue. and we all know it's the engine that's the
But
oxygen of the world.
Do you see American consumers noticing an uptick in their gas prices?
I don't. I think the price of oil will go higher, but it will be the money will be made more in petrochemicals. So I don't think, listen, there could be a 10 to 20% shift, but we're not going to see the shift we saw in 08, 09 when we were $3, $4 a gallon. That was an anomaly. So I think we're forecasting oil prices between $80 and $100 a barrel, and we're forecasting prices at the pump between $2 to $2.50 a gallon.
Fantastic. You know, Stan, a lot of the stocks you were talking about, you're either a shareholder or you're part of the advisory board. We're not telling our audience to go out and buy these stocks, but I think they're worthy of at least consideration. People doing their homework. If it's suitable for them, you should think about it, because when you got an expert like this who thinks it's worth being in his portfolio, you might want to take a thought or two about having it in your portfolio. I know you're an expert in many things, oil, all commodities, mines, minerals, resources. Maybe you can come back from time to time when we have things happening with the global economy and give us your unique take on it.
It would be a pleasure, and thank you very much. I want to make one last comment that the bulk of the opportunities are going to be in emerging markets. Africa over the next 10 to 20 years is going to be the basket for commodities. Richest countries, I know politically troubled, and I think some of the actions that your president is taking, I think, are very positive in this regard.
Very good. It's rare on television you hear people saying nice things about our president, but on Liquid Lunch, we try to do it as much as we can when he deserves it. You deserve experts like Stan Bharti. Check out his thoughts for your portfolio. Stay right there. We're going to take a 2-minute break, come back with Manny Alicandro right after this.